Hello, Munchkins. Hello, Munchkins. Oh. Welcome to episode 2 of Market View from a Garage. Yeah, Market View from a Garage. If you've noticed, the background is red. It's because the markets are bleeding. And I've tried to keep myself away from the market on this weekend so I don't get biased. By market I mean from watching like economic reviews, macro reviews. Just wanted to make this video as unbiased as possible. Okay. And today we're going to talk about a beautiful country that's in a galaxy far, far away. And the reason we're gonna talk about it is because sometimes in life, when a red stares you straight in the face, and this is coming from a Taurus, okay? If the red stares you straight in the face, maybe the answer is not that far, it's not that complicated, and it's somewhere where it is also red. In our case, this is 100% true because we're going to talk today about Japan. We're going to talk about these guys, alright? The two sword fighters, the samurais. Okay? Why Japan? Why should a little guy in other parts of the world worry at all about the Japan? And that is because when shit hits the fan, such as in this example, okay, when it hits the fan, you have systemic issues. Now, this is S&P 500. This is a global asset, okay, in a lot of portfolios. And if this asset has this kind of a waterfall structure, then you have a global problem, okay? When you have a global problem, or whenever there's an issue with anything in this world, be it politics, economics, doesn't matter. You always, let me zoom in to make this statement clear. You always follow the money. Okay? Now, what does money tell us here? Money, let's examine this. Okay, this is the panic part. This is the part that we're interested in, alright? This is S&P, going very well, all good. Printed massive day, and the next day sold off completely. So there was a change of direction, change of mood, if you want to say, if you want to put it that way. Changed the mood. It tried again. It did higher high, failed. Shit hit the fan, tried to come back and couldn't. Now, It tried to come back at this level, okay, which is here. So basically the close of this day, something happened on this level. It got penetrated down, went up, and couldn't break it. Why this level is important? I'm not gonna answer that question, but I will let Mark Douglas answer that question.
When the market stops at a particular price, it means there wasn't anybody in the world at that point that was willing to bid it one tick higher or offer it one tick lower. When it reaches that point again, you have to ask yourself, is there enough momentum here? Is there enough conviction in the market for someone to actually bid it past that price? That's the kind of assessment that you make when you're trading from a subjective point of view. When the market would come up to resistance or down to support, basically all you're looking for is pretty much the same people that supported the price the last time. They bought, they absorbed all the sell orders with enough conviction to rally the market, and so they made money. Chances are they're going to do it again. Trade it until it doesn't work anymore. The reason why I understood that is because I actually knew the traders who did
it. Mark. Now, this systemic problem here, what the system shows us, didn't go past this point. Why did all the traders in the world who take participation in this market didn't go higher than this? Alright? Higher than close of this day, which in particular was July 11th. Excuse me. July 11th. Okay? Now, if we look at the world as a system and as a money flow, we have to understand who gives out or which money participates most in this trade. And the answer is unequivocally these guys. Alright? And the reason for that is, the reason has been there for the last 20 years. So last 20 years, Japan had zero rate interest policy. Okay? And people took advantage of that, and they performed a carry trade. Alright? What carry trade is you basically take the bonds in Japan for 0% and you invest it in some particularly sometimes often emerging economies like Mexico and Africa, and you make a bond arbitrage. You make money off of that. Now, because of this carry trade, Japan became one of the largest foreign investors in the world. But they have done something recently, which is they changed their interest rate policy, first time in 20 years. Completely insignificantly, by 0.25%, big deal. You would think, is it a big deal? But system shows apparently it is. Now, change of rate happened a few months ago, okay? And what's the surprise? There's no surprise in the market. Why would it reverse like that? Well, ideally, Japan actually increased rates because of a few things. But most importantly, it's because Japanese they're trying to fight deflation because they're aging, okay? They're aging, and if you know Japan, they work really hard, and it's very hard. If everyone works really hard, it's complicated to raise productivity even higher. Alright? So they have to increase rates. But this is no news to markets. Rates increased, market should be able to absorb that information. But the system shows that somewhere in this period they didn't like it. And what happened? Somewhere in this period, they didn't like it. My system didn't like it. Now, why did the system not like it? I'll let an extract answer this question. This extract comes from Professor Patrick Boyle.
Samurai bonds. This debt has mostly been issued at fixed interest rates, which means that the change in interest rate should not affect the borrowers. But if the yen were to appreciate against their currencies, it would be more expensive to pay back these loans.
Now, samurai bonds. And the whole reason I used this picture. That carry trade, that foreign investment carry trade, is called a samurai bond. Okay? And this bond, this trade, is experiencing problems. This trade would experience problems if there is alternations to the currency. Okay? Because if currency appreciates, the government debt servicing becomes harder. Okay? Japan also abandoned a yield curve control. We don't care about that. That's very complicated. All we care about is currency appreciated. If the currency appreciates, it's harder to service the debt. Okay? Now, coming back to our market view from a garage, the view is this red candle on the 11th of July. Okay, what else happened in the markets on 11th of July? Let's look at the currencies. This is our basket, pretty much going in tandem. However, one currency changes direction sharply before any other did, and that's yen. Alright, and when did yen double bottom and change its direction? Sorry, I'm poor. That happened around here. What day was that? That day was 11th of July. This means, ladies and gentlemen, the second Japanese yen started appreciating. Well, servicing all those international investments for other players outside Japan became terribly harder. And hence, we are experiencing this sort of a waterfall. Okay? Now, if you check FinTwit, this is peak to trough about, 7%, 8%. Okay? But if you check FinTwit, it looks like we have dropped 50% and COVID is back, but it's not. What do we know about declines of the market? The waterfall liquidations like that, okay? We will adapt to problems. I'm sure the market will find the bottom and it will reverse. Alright? But FinTwit shows that there's a great panic. Is this panic justified? No. You know why? Because panics are never justified. You should never panic. In any situation, it's gonna make it worse. Why? Well, I'll let a legendary stock investor answer that question. Here's an extract from Peter Lynch.
You should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years of century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
Okay. Okay, Peter. So, you know, take advantage of the volatility in the market, as Peter says. Now, Peter's words should be taken with a pinch of salt. The reason for that is, thinking is a good servant, but a bad master. And the reason for taking his words with a pinch of salt is this. Anyone knows what this is? This is a yield curve. Now, if we completely expand the view on a yield curve to the earliest available point, which is 1980s, and we look at the gray areas, which are recessions, we know that every time yield curve inverts, we'll face recession. This happened 11 times, 10 or 11 times out of 11. It has an immaculate track record. And as you can see, the yield curve is inverting right now. Now, to understand how big of a generational opportunity this is, you have to understand that recessions, they hit markets. They hit markets generally within the 11-month grace window. Statistically, when they occur after the curve has inverted. Okay. May I correct myself? Not the yield curve. After the rates have been posted. The last rates that have been posted was in either September or October 2023, which is when we had the bull going up. And 11th month ironically falls on November 2024. which is kind of an issue because that's gonna be elections in the United States. So something very weird and interesting, and a few narratives are going to be entangled together. But generally 11 out of 11 times after rates are posted and this thing reverses, we have a recession. And given how much the political sphere of United States doesn't like Trump, this could be a hot potato that they will pass him. It could be a hot potato, okay? Now, politics aside, you have to understand that we're within this period. So the risks are high. Although Lynch is right. Okay? Risks are high. I think it could be that the risks are higher than they should have been, because because of, again, Japan. And besides samurai bonds, there's a second more important problem with Japan, and that is Japan imports every drop of its oil. Geopolitical tensions, such as the Middle East, problems with Iran, and supply issues will make it problematic. Okay? Supply issues are generally push the prices higher, and if the price for oil goes higher, and Japan is extremely dependent on oil, extremely, then this kind of a thing can play out way lower. Third, this thing may play out even lower because of the way it came back up here. And as noted in the previous video, bull markets are largely based on corporate buybacks. When corporate buybacks occur, it goes up. Now, what do corporate buybacks mean? Essentially, corporate buybacks means corporations have a lot of money, they wanna, for one reason or another, investor, shareholder, doesn't matter, or narrative, they all agree, they all play, golf in the same golf club. They're like, Peter, are you buying back? I'm buying back. You're a CEO, I'm CEO. Let's push this shit up. Anyways, TLDR, they buy back. What happens when you take billions of dollars and you buy back the stock is you extract it. You take that stock and you remove it from the market. Okay? This creates something what in penny stocks world is called extracted float. If you extract the float, there's less shares standing at a particular price behind the market. There's less shares standing behind the price. Sorry. So the more buybacks you do, the more volatile the market becomes. Alright? So if you buy back a lot and you push it up that fast, that high, without adding significant productivity, it just means you extracted the float, the price jumped the gaps, went up, stopped somewhere, and in our case, and reversed. In our case, that stop was the currency appreciation of yen, on top of which the oil restraint, okay, on top of which geopolitical problems that can be caused by Middle East, because there are a lot of oil exporting countries there. So that's an issue. All right, lots of issues. Now, if transportation, if you want to study, let me mention this first. If you want to study like more of Japan and what Bank of Japan does, you should definitely give a look at all the works that Western Nakamura does. He does a very good review of this. More detailed and technical, but general picture is like this. Now, if transportation or shipping problems occur, for this you look up what's going on with shipping on YouTube. It has excellent reviews. Transportation issues occur, you have to reroute. If you have to reroute, you have to spend dollars to reroute, to readjust. When you spend dollars, you increase inflation. Okay? If you increase inflation, if you are a Japanese government and the world inflation increased, the inflation runs hot and you just increased your rates, and you're fighting exactly that problem, you're fighting the deflation, you can overdo it. Okay? If you overdo it, you might run into higher rates. Okay? If you overdo it, the problem becomes bigger, because Japan is also one of the largest foreign holders of US government bonds. So if issues in transportation occur, money gets spent, inflation runs hot, and Japan sees a significant inflation, they will start selling US government bonds. Okay? And geopolitically, this might mean another war is coming. Because if inflation rises and you cannot control it, you basically have problems with servicing debt. Okay? And people will just start selling the asset. And today, it so happens that we have a lot of debt in the world. Okay? Massive amount. It's some say it's big. Okay? 35 trillion as a percentage of GDP, whatever it is measured in. But Japan is running 225, 230% of debt. So this debt can go much higher. Unless no one agrees to participate in the system. If inflation comes and there's too much debt, no one wants to participate in the system, that means actors do not want to collaborate with each other. And that means only one thing: war. But I wanted to finish this video on a positive note, but also a not so one. Okay? So this was episode 2. Thank you very much, and enjoy your week.
Oh, lots of debt. All the countries have debt. So that's weird. Like it's really, like, there's so much debt. When you calculate it together, there's more debt in the world than there is money. So probably it will get paid. It's impossible. It's weird. Like they're actually, like, how do we pay it? We have to, like, borrow something from another planet. That even possible? How all the countries can be in debt is that countries don't owe money to each other, but they owe money to banks. So I've been thinking, if countries owe money to banks, how stupid are the countries to pay it back? Because a country has an army. A bank has 4 cashiers and a cleaning lady. We have to pay. They have sent us a letter. If we don't pay now, they might send another letter. What do we do then? We have a nuclear submarine, but they have a stapler.
Thank you very much, ladies and gentlemen. Stay sharp, stay valiant, and stay vigilant.
Play the guitar on the MTV. That ain't working. That's the